Hi, welcome to Armanino's webinar. We're going to begin on ASC topic 842, New Lease Accounting Standards. And this is a really popular event. We've got a huge crowd on the line ready to listen. My name is Lori Colvin, and I'm the partner in charge of marketing here at Armanino, and I will be your moderator for today. Thank you so much for joining us, first of all. Let's do a few housekeeping items about this webinar. What you'll want to do is to minimize or maximize your webinar pane. You can use that little red arrow button, and we really do encourage you to ask questions throughout the webinar. You can just type in your question in the chat box, and at the end we will get to those Q&As, provided we have enough time. We'd also like to make sure you can hear us correctly, so you'll want to make sure that if you're using a telephone to click the phone call audio option, but if you're listening through your computer, just go ahead and click the computer audio. I wanted to take a few seconds to review the CE requirements, because if you do want CE, there are a couple requirements you have to meet. One is that you use a personal computer, not on your smartphone, and you log in with your own unique URL. And you need to be logged into the software for 50 consecutive minutes within the scheduled time frame of the webinar. And when we ask you polling questions, you have to actively respond to at least 75% of the polling questions. So you might as well just respond to all of them. And then at the end, we have an evaluation survey that you'll want to take. So now it is my pleasure to actually introduce our two presenters. First, we have Grant Lamb, who is a partner here at Armanino in the audit practice with 15 years of experience in public accounting, and he's actually the firm's lease accounting expert. Grant is out of our San Francisco office and works with a bunch of different industries, including financial services, leasing, mortgage lending, nonprofits, and private schools. Next presenter I wanted to introduce is Tom Gard. Tom's got 30 years of experience in public accounting and actually served as a former CFO and COO inside. So he's got a lot of experience on both being in public and in private. He works with leasing companies and has been on both the lessor side and the lessee side of transactions. So next, I wanted to talk about the learning objectives of this webinar and what you can anticipate. So today we're going to discuss why the FASB issued the new lease accounting standards and how it will represent an improvement from the current reporting model. We'll examine how leases will be accounted for under the new standard by lessees and lessors, and we'll provide recommendations on what you should be doing now in preparation for the new lease accounting standards. So it's my pleasure to pass this over to Grant Lamb as he goes through some of the overview.
Thank you, Lori, and good morning, everyone, and thank you very much for joining our webinar today on the new lease accounting standards. Changes in lease accounting have been discussed for quite some time now, and the FASB just released the final guidance earlier this year. So the objective of today's webinar is to present you all with an overview of that new standard. And we do mean overview because the new standard is quite comprehensive, so the intent certainly is not to go through the new lease accounting standards in detail, but rather present an overview. We'll start by providing a background on the new lease accounting standards. I'll talk about the reasons the FASB issued the new standard and why it represents an improvement from the current lease reporting model. Tom will then provide a high-level overview of the current and new lease accounting and point out what has changed and what has remained consistent. I'll then talk about the definition of a lease, because what is considered a lease is slightly different now under the new standard, so we'll talk about what that means. And then we'll get into how leases will be accounted for under the new standard, both from the perspective of the lessee and the lessor. Two leasing transactions that have been impacted by the new standard are sale-leaseback transactions and leverage leases. So we'll talk about how the new standard impacts these types of transactions. And then very important to note are the effective dates and the transition. So Tom will cover the important dates that you want to mark your calendars with and how you would go about transitioning to the new standard. And for the third part of our webinar, we'll focus on planning for the change. So we'll discuss best practice recommendations on how organizations should be planning for the change, what you should be thinking about now, how to best implement, and also considerations towards taxes. Okay, so the new lease accounting standards are probably the most significant change to GAAP in recent memory. And creating the new standard, getting it issued was a massive undertaking that required a great deal of effort by a lot of different people. So what were the FASB's objectives? What were they trying to achieve? One of the main objectives was to increase transparency. So the current lease model has garnered a lot of criticism, primarily because liabilities or commitments from operating leases were kept off of the balance sheet. So financial statement users felt that the balance sheet did not accurately represent an organization's true obligations. As a matter of fact, when the FASB first started looking at revising the lease accounting standards back in 2005, a report came out that showed about $1.25 trillion of lease commitments from operating leases were kept off the balance sheet by SEC registrants. Again, these are commitments that companies had entered into for minimum required lease payments, but they were not presented as a liability on the balance sheet. So one of the primary objectives was to provide for a more faithful and accurate representation of an organization's leasing activities and of its true obligations. So while the main objective is to improve transparency, there are other objectives as well. One of the other objectives is to align the lease accounting guidance with the new revenue recognition standards in Topic 606. So from the perspective of a lessor, a leasing activity is a revenue generating activity, but the current lease accounting model was derived from and it's aligned with the previous revenue recognition standards. So the new lease accounting rules better align some of the terminology with and concepts with the new revenue recognition standards. And then consistent with the objective of making the financial statements more transparent and useful to the users, the new lease standards also call for additional enhanced disclosures, both qualitative disclosures and quantitative disclosures. And we'll talk about that later on this webinar as to what those enhanced disclosures are. Overall, the FASB believes that the new standards are an improvement from the current model, primarily because of the reasons we talked about by adding more transparency and making the financial statements more comparable and easier to understand. But also the new standards makes it more difficult for organizations to achieve off-balance sheet transactions. So it creates fewer opportunities for organizations to structure leasing transactions and keep them off of the balance sheet.
Okay, so we are now going to go to our first polling question. And remember, for CE, you do want to answer 75% of these questions. So our first question is, what are the objectives and reasons for issuing the new standard? Is it improve transparency of leasing transactions, align lease guidance with new revenue recognition standards, create fewer off-balance sheet leasing transactions, or all of the above? So you'll want to answer A, B, C, or D. And we leave the polling open for a few seconds here so everybody has an opportunity to vote. And we'll close the polling in 3 seconds. We'll say 3, 2, 1. Great. So Grant, do you want to take a look at the answer here?
Sure. After last night, I don't know how much confidence we can place in polls anymore, but this poll is accurate. Looks like we have a bright audience out there today, and 91% of you got that polling question correct. It's the objectives were to meet both all A, B, and C.
Hi, welcome everybody. This is Tom Gard, and we appreciate you being on the webinar. I think in looking at the differences between current standards and the new standards, it's always helpful to review how we account for leases today, and in fact have, over my entire career, accounted for them very similarly. There's been some minor modifications, but the lease rules really go back to FASB 13, so way back in time. And maybe some of the newer people don't know that, but I certainly knew it very, very well. The current lease standards classify leases into two categories, operating and capital leases. And really, in talking about a capital lease, there were 4 tests that would be applied to determine if a lease was a capital lease. Most of these tests dealt with some sort of incidence of ownership by the lessee, that the asset being leased was really theirs, and it was more of a financing than a rental situation. For example, the first 2 categories dealt with contractually even a direct transfer of title in the lease to the lessee by the end of the lease. The second one was a bargain purchase option. So those first 2, because it was a bargain purchase option, it's very likely that the title in the asset was going to end up in the hands of the lessee by the end of the lease. The other 2 dealt with the use of the asset, the period of time that the lessee was using it. If the lessee was using it over 75% of the lease term, it was felt that that qualified as a capital lease. And then the last one dealt with the amount of payments that were made on the lease. So if the present value of your payments equaled 90% of the current value of that asset, it was felt that you're really buying this asset versus just renting it. Now, if it was determined to be a capital lease, that meant the transaction ended up on the balance sheet. The asset was on the balance sheet, and then there was a corresponding liability. We'll review the accounting for some of this in a later slide, but the important factor is those were on the balance sheet, all capital leases, with appropriate disclosure then in the footnotes in much the same way that a note disclosure was, showing a 5-year payment, maturity schedule, etc. for the capital leases. Now, operating leases were leases that did not qualify under any of those 4 criteria. Operating leases, as Grant mentioned, were kept off the balance sheet by the lessee. Really, the only disclosure, there was disclosure in the footnote, really just saying the aggregate amount of payments for the operating leases over the next 5 years. There were general descriptions of what operating lease commitments companies had. For example, their facility leases or copier leases, etc., with some general terms. But then it was aggregate information for the operating leases as far as the payments that were going to be required over the next 5 years. Now, the new lease accounting standards still deal with the classification to 2 categories of leases. Instead of being capital and operating, they've revised the term slightly. It's now known as either a finance or an operating lease. Now, in doing the classification between the 2, there are still the old 4 tests that were applied previously that I just reviewed, although they've been modified. And they've really been identified more as guidelines in determining whether the lease is a finance or operating lease. And then a 5th guideline has been added as well. So again, in determining whether it's a finance lease, you would look at whether there was a transfer of title or a bargain purchase option. The criteria of the lease being 75% of the useful life of the asset, that bright line of 75% has been removed. Now it's substantially the life of the asset, so there's a little more judgment involved. You don't have that bright line. And the 90% test isn't a 90% test anymore. Again, it's the payments are substantially all of the cost of of the lease. So those still remain in our guidelines in determining whether it's a finance or operating lease. A fifth criteria has been added. If the asset is of such specialized nature that really it's of no use to the lessor after the lease, then that also would qualify as a finance lease. Now the key difference, again, going back, capital leases were on the balance sheet, finance leases will be on the balance sheet. The key difference in the new guidance is that now operating leases will be recognized on your balance sheet. There will be an asset and a liability relating to this operating lease. The whole concept goes back to really the right to use an asset. For example, I have the right to occupy this building in my facility lease, or I have the right to use these copy machines or these autos, etc. So the FASB wanted to get these assets on the balance sheet, but more importantly, the liability, the commitment. So now lessees will recognize both a right of use asset and a corresponding liability. And we'll talk a little bit about how those are quantified in a later slide. But it's important to note that these assets will be segregated from the categories they previously might have been put into as a capital lease. For example, if it's a auto, for example, and it was for whatever reason a capital lease, it would have been in your property and equipment under your category of vehicles. Now the asset is going to be segregated and be a right of use asset. And so it'll be clear to readers of financials which items are leased and which are owned by the new model.
Okay, thanks, Tom. Before going into further detail regarding the new standard, let's look at the definition of a lease, because what is considered a lease is slightly different now under the new standard. So we need to first determine whether or not a contract or an agreement is or contains a lease that would fall under the scope of lease accounting. So under the new standard, a contract contains a lease if such an arrangement conveys the right to control the use of an identified asset. So there's 2 points of emphasis here. One is the identified asset, and number 2 is the right to control that identified asset. So an identified asset can be explicitly or implicitly stated in the agreement, and it could be assets such as aircraft or autos, engines, equipment, etc. But there needs to be an identified asset. The second piece to the definition of a lease is a right to control. So in order to have that right to control, the customer must have 2 things. One is the ability to obtain substantially all economic benefits from the use of the asset. And number 2, to have control, you must have decision-making authority over the use of the asset. So again, to summarize, in order to have control, there's 2 elements. There's both a power element and a benefits element. So you must have the power to direct the use of the asset, and you must have the ability to receive the benefits from the use of the asset. So this new definition is very similar to the current definition. The key difference is that the new definition incorporates in this concept of control, whereas under the current GAAP guidance, a contract can be a lease even if it did not transfer control. Under the current GAAP guidance, the critical determination has always been whether or not a lease is an operating lease or a capital lease. As Tom mentioned, liabilities were only recognized for capital leases, and commitments from operating leases were kept off the balance sheet. So that's always been the critical determination. Under this new GAAP guidance, the critical determination now isn't so much whether or not a lease is a finance lease or an operating lease, because essentially liabilities will be recognized for all leases. Now the critical determination is whether or not a contract is or contains a lease that would fall under the scope of lease accounting.
Let's review the accounting from the lessee's standpoint. of the two classifications of leases, being finance and operating. In the upper section that's shaded, you'll see the accounting for finance leases and the effect on the balance sheet, income statement, and the cash flow statement of each. You'll find this is very similar to current guidance on capital leases. For example, on the balance sheet, you will have an asset and a lease liability. Those will be measured at the present value of the lease payments. The one difference here, as I mentioned earlier, that asset will be segregated into a right of use asset versus being blended into, for example, property and equipment or another category of that nature. The income statement effect, the asset will be amortized to expense over the useful life, and there'll be an interest expense component dealing with the lease liability as payments are made. So again, identical to the treatment of capital leases in our current guidance. On the cash flow statement, principal repayments are going to be presented in the financing section of the cash flow statement, and interest expense is embedded in net income in the operating section. So again, finance leases, the accounting is very, very similar, if not almost identical to capital lease treatment, really except for breaking out the right of use asset. The real change, as we mentioned, is under operating leases, where operating leases previously did not appear on the balance sheet. Now they will. You will have, for operating leases, a right of use asset and a lease liability, and those will be measured the same way that finance leases are, at the present value of future lease payments. Now, the income statement effect of operating leases will be slightly different than those of finance leases. A finance lease broke the expense into amortization expense and interest expense, while our operating leases will recognize a single lease cost recognized on a straight line basis over the lease term. This is very similar to the income statement effect of operating leases now, which were recognized on a straight line basis over the lease term. So the income statement really hasn't changed. The big change is on the balance sheet, where you have the right of use asset and the lease liability. And we'll keep harping on that because that is the major change. And as readers of financial statements look at this, that'll be very, very important. I think the FASB decided to segregate that right of use asset to make it a little easier for readers to segregate those from other assets if they choose to do so, meaning if you're a banker or other readers of financial statements choose to evaluate those leases a little differently for loan covenants or what have you. The cash flow statement effect is the same as current as well. The lease expense, which went through the income statement, is embedded in net income or loss in the operating section of the cash flow statement. Now, it's important to note that we keep saying all leases will be on the balance sheet. There is one exception. Short-term leases of 12 months or less, those are permitted to not be recognized as the lease asset and lease liabilities. They're considered of such short term that putting them on the balance sheet doesn't serve as much purpose as the longer term commitments that other leases would have. So again, if you have a lease of 12 months or less, that's not required to go on to the balance sheet. Optional payments, which might be renewal payments, etc., would be included in your calculations for determining your lease asset or liability only if the exercising of the option is reasonably certain. Again, that's going to be a fact and circumstances case. Sometimes that's very clear that it's going to be exercised. The terms are so favorable. Other times not so. So that will involve a little judgment in measuring the present value of lease payments for recording the item on the balance sheet.
Okay, thanks, Tom. So now we shift our focus to the lessor accounting. So as Tom pointed out, the lessee accounting has significantly changed, but the accounting applied by the lessor has remained relatively unchanged from current GAAP. But we will provide a summary of the lessor accounting as a refresher of sorts and point out where the accounting has changed. So the lessor will continue to determine if a lease is a finance or operating lease, and finance leases will be classified as either a sales type lease or a direct financing lease. So to make that determination, you would go through the standard 5 criteria that Tom mentioned earlier. If it meets any of those standard 5 criteria, it would be considered a sales type lease. If it doesn't meet any of the standard 5 criteria, then you either have a direct financing lease or an operating lease. And the key determination would be whether or not the present value of lease payments, including third-party guarantees, equals substantially all of the fair value of the asset. If it does, then it's a direct financing lease. If it doesn't meet any of the 5 standard criteria, and if you include in the third-party guarantee that still doesn't cover the substantially all of the asset's life test, then you have an operating lease. Under current GAAP, the key distinction between a sales type lease and a direct finance lease is whether or not there's upfront profit on the transaction. If there is upfront profit, then it's been a sales type lease. If not, then it's a direct finance lease. This new guidance is slightly different now in classifying sales type or direct financing, and it moves away from whether or not there's upfront profit, but now we look at whether or not third-party guarantees are used in determining whether or not the future lease receipts equal substantially all of the asset's fair value. Sales type leases do not include third-party guarantees, while direct finance leases do. So as for accounting for leases under the new standard from the lessor standpoint, if you determine you have a finance lease with respect to the balance sheet for both a sales type lease and a direct finance lease, you would first derecognize the asset, so take the asset off the books, and you would replace that asset with your net investment in the lease. And that net investment in the lease would consist of the lease receivable and any unguaranteed asset value, which is essentially the lessor's estimate of the value of the asset upon return to it at the end of the lease term. So all that's relatively unchanged from current GAAP with respect to the balance sheet treatment. With respect to the income statement, the lessor in both a sales type lease and a direct financing lease would recognize interest income on a rate that's implicit in the lease term. The difference between a sales type and direct finance lease would be how you treat any gain or loss from the transaction. If you have a sales type lease, any gain or loss is recognized in its entirety upfront at lease commencement. If you have a direct financing lease, a selling loss is recognized upfront in its entirety, but a selling profit is deferred over the life of the lease. Again, all of that has relatively unchanged from current GAAP. With respect to the cash flow statement, for finance leases, principal payments will be presented as a financing activity, and interest will be presented as an operating activity. So that's how lessors would account for finance leases. Now, with respect to operating leases, the accounting under the new GAAP is relatively unchanged as well. The vast majority of operating leases will remain as operating once this comes into effect, and the accounting for the most part will continue as is. So the lessor will continue to recognize the underlying asset on the balance sheet and depreciate it over its estimated useful life. Lease receipts will be recognized as lease income on a straight line basis over the life of the lease. Again, that's relatively unchanged. And then all cash received will be presented as operating on the cash flow statement. So a few changes here, but overall fairly consistent, certainly not the magnitude of change that Tom talked about with the lessee accounting. So just to recap, as we mentioned, lessor accounting has remained relatively unchanged, and to some extent, people may think that the not much focus has been placed on the lessor accounting, just given how much focus has been placed on the lessee accounting. But there certainly are some changes here that we talked about and you want to be aware of if you are a lessor. Again, the key changes to the lessor accounting were made to align the lessor accounting with the lessee accounting. So a few terms and definitions were updated, but also the lessor accounting was updated to align the lease accounting with the revenue recognition standards in Topic 606. As we mentioned earlier, the current lease model was derived from the previous revenue recognition standards, and now with 606 coming out, there were a few changes to align the lessor accounting, a new lessee, or the new accounting guidance with the new revenue recognition guidance. For example, whether or not a sale of an underlying asset in a sale leaseback transaction, whether or not a sale has occurred, now depends on whether or not the lessee has obtained control of that underlying asset. And that's consistent with the transfer of control principle in Topic 606.
Okay, we are going to go on to our second polling question, and this is going to be a true or false. Lessees will have to recognize a right-of-use asset and lease liability for all operating leases in excess of 12 months. Is that true or false? So we're going to give you a little time to answer. So we'll close the poll in about 3 seconds. So you want to hop on. So 3, 2, and 1. Okay, Tom, do you want to let the crowd know?
Our polls are very consistent today. We've got a 91% on the first one and a 91% on the second one. The answer is true, that all leases in excess of 12 months will be required to be shown on the balance sheet as a right-of-use asset and a right-of-use liability. We've had a few questions regarding the length of the lease as it stands right now, which I think we'll be answering as we get to transitional topics. And so I've seen a few of those questions pop up, so hopefully we address that in a couple of slides.
All right, so now we'll turn our attention to sale-leaseback transactions. These are fairly common leasing transactions in which one party that owns the asset sells that asset to another party and then leases back that same asset. Now, these types of transactions have been popular for the seller lessee because it's used as a means to generate cash flows. There could be certain exposure risk associated with owning the asset, so selling it mitigates some of that risk. And in certain transactions, it can result in less liabilities on the balance sheet. And the current guidance has very specific criteria for determining when a sale-leaseback transaction has occurred, and the new accounting guidance adds a few new concepts as well. As we mentioned earlier, one of the objectives of the new lease accounting standards is to align itself with the new revenue recognition standards, and how that impacts sale-leaseback is that in order for a sale-leaseback to qualify as a sale-leaseback, there first must be a sale of an asset. And a sale must meet the criteria under Topic 606, which is the new revenue recognition guidance. So for a sale to occur, the seller must have transferred control of the underlying asset to the buyer. And actually Topic 842 references Topic 606 for determining when a sale has occurred, and also provide indicators of when control has been obtained. And as part of determining whether or not a sale has occurred, we also have to look at the terms of the lease back. So if the terms of the lease back results in a finance lease, then no sale has occurred. So if an organization is, the intent is to set up a sale leaseback transaction, but it doesn't end up meeting the criteria of a sale, then essentially what you have is a failed sale. It'll be treated essentially as a financing transaction by the lessee and the lessor. Essentially, the seller hasn't sold the asset but has mortgaged the asset. Certain sale leaseback transactions may also include a repurchase option where it allows the seller lessee the ability to buy back the asset at the end of the lease term. So if there is a repurchase option, it must meet two criteria in order for the entire transaction to qualify as a sale. Number one, the asset must be non-specialized. So that means there are alternative assets available out in the open market. And number two, the repurchase price is the asset's fair value at the time of the exercise. So if there is a repurchase option, it must meet these two criteria to qualify as a sale. And again, if it doesn't meet any of these criteria, then you essentially have a failed sale, and it's really just a financing of that asset. So based on the new guidance of determining when a sale has occurred, you could have certain transactions that previously did not qualify as a sale, but will qualify as a sale under the new guidance, and vice versa. And also one thing I should point out is that under current GAAP, there's a separation between real estate and non-real estate assets in the guidance. Now it moves away with that bifurcation, and all types of assets, real estate and non-real estate, are under one set of guidance. Another leasing transaction that's impacted by the new standard are leveraged leases. So leveraged leases involve three parties. There's a lender, a lessor, and a lessee. And essentially, the lender provides funds to the lessor to go and finance and purchase an asset, and then the lessor leases that asset to the lessee. Leveraged leases have been popular for tax reasons because it essentially allows the lessor to make a relatively small investment in the asset, but still recoup and take the full depreciation on the asset. So for organizations that do utilize leveraged leases and is part of your business strategy, the new standard have been somewhat unpopular because it does away with leveraged leases. So leveraged leases entered into after the effective date will no longer be recognized. However, leveraged leases that are entered into prior to the effective date will be grandfathered in. So for organizations out there that do engage in leveraged leases and do utilize it as part of your business strategy, you may want to consider entering into these transactions prior to the effective date in order to receive the grandfathered treatment. So we mentioned earlier, one of the objectives of the new standard was to make financial statements more useful to the users. And with that, the new standard expands on the disclosures that now you're required to include. Overall, the objective of the enhanced disclosures are to enable users of financial statements to better assess the amount, timing, and uncertainty of cash flows from leases. Really, the intent here is to include enough information so that the users really understands an organization's leasing activities and of its future cash flow commitments. So the enhanced disclosures include both qualitative disclosures and quantitative disclosures. Examples of some of the qualitative disclosures would be disclosing the nature of the leases, so disclosing the lease terms, disclosing the options to extend or terminate the lease, disclosing any residual value guarantees, and other general pertinent information. Another example of a qualitative disclosure would be disclosing information about leases that haven't started yet but create additional rights and obligations to the lessee. And also you're now required to disclose any significant judgments or assumptions made, including whether or not a contract is or contains a lease, whether or not a certain sale and a sale leaseback has occurred. So you're now required to disclose that type of information. And then examples of quantitative disclosures would include disclosing the total finance or operating lease costs, including maturity tables, disclosing the weighted average remaining lease term and discount rate. So a lot of the disclosures are currently required as well, but you'll find that a lot more are new and new required disclosures. We certainly did not cover all of the new required disclosures here, but there is guidance out there, and we certainly can help you determine the scope of the new additional disclosures. As a best practice, we would recommend that you start now by meeting with your auditors and your consultants and your accountants to determine how this new enhanced disclosure will impact your organization, and assess the level of effort that may be required to gather the necessary data information to meet these new disclosure requirements. I wouldn't underestimate the level of effort that's going to be needed to gather this information, especially for organizations that do engage in significant leasing activities. It could be a lot more data that you'll need to compile to meet the new disclosure requirements.
Effective dates. The good news is we've got some time to gather information and to get your systems in place to measure both the amount of the lease obligations that will need to go on the balance sheet and the disclosure information that Grant was just alluding to. Public companies, this is effective for fiscal years beginning after December 15, 2018. So essentially calendar 2019 is when public companies, this will be effective. And private companies have an additional year. So fiscal years beginning after December 15th, 2019. So again, essentially calendar 2020. So we've got a few years here. I would caution you not to wait until we get down to 6 months before the effective time or a year before the effective time, especially if you're involved in significant leasing activities, because just gathering the past information might be more than your systems can handle. You may need some systems upgrade or some other information. So taking a look at this early on is recommended. Now, as far as those are when the standard is effective. Early application of the standard is permitted for all organizations. So if someone wants to jump into this right away and get all the leases on the balance sheet, that is permitted for all organizations.
I had a client ask me the other day whether or not there's any benefits associated with early adopting the new standard. First of all, I'm not hearing of any companies rushing out there to early adopt the new standard, but there certainly could be some benefits with early adopting, primarily to align your lease accounting with the new revenue recognition standards. But we certainly wouldn't recommend that you early adopt until you've had the full opportunity to really understand the lease accounting guidance and how it impacts your financial reporting. But there could be some benefits.
Let's talk a little about transition and how these changes will be embedded into your financials as you go forward. The accounting transactions will be recorded using what's called the modified retrospective approach. That means you're going to go back, really you need to take a look at your financial statements and determine how many years are you presenting. And really the earliest year presented in your financials will need to be adjusted for the lease standards. So the lease asset and liability will have to go back, whether it's 1 year, 2 years, depends upon how many comparative periods that you're showing on your financials. You really have to go back to the beginning of the year of the earliest year you're showing. So the effects on statement of cash flows and income statements are all measured properly. So for example, if you're sitting there in 2020 and you only show 2019 and 2020, you need to go back to the beginning of 2019 to put those leases on the balance sheet then and account for them going forward, including any new leases that are entered into from that date forward. We've had one question came up about a current lease that was in place that now only has 12 months or less than 12 months to go in its term, and does that have to be recognized on the balance sheet? I'd say it depends upon the number of periods that you present in your financials, because if you're showing comparative financial statements, you'll need to go back to the prior year, and now I'm assuming the lease is over a 12-month term. And so then it would be reflected on there. So it kind of depends on your individual circumstances and the periods that you're presenting in your financial statements. Now, the standard did build in some practical expedients, hopefully to make this easier, the transition. These practical expedients have to be adopted as a package. So you can't pick and choose when you're going to use the practical expedients for one lease versus another. But essentially, what it said is that there is no need to reconsider the classification of leases before the effective date. So if you've already determined, here's my capital leases, here's my operating leases, there's no reason to go back and look at every lease, lease by lease, to determine if the new guidance would change that decision at all. You'll continue to classify operating leases as operating, and the previous capital will be finance. There may be some differences between the old guidance and the new classifications based on the new standards, but those are expected to be relatively infrequent. But again, the practical expedients are there to allow an easier transition. Now, new leases entered into would have to follow the new guidance, but the practical expedients refer to all previous leases that exist at the date that you're adopting this. As Grant mentioned, existing leverage leases are grandfathered, and previous sale leaseback transactions don't need to be reassessed to determine if a sale has occurred. So they're trying to let the classification and the decisions made in the past lie as they were and just follow those through the end of the transaction, but all new transactions that are entered into the new guidance would be applied to.
All right, we are going to do our third polling question. And on this one, you're going to pick the statement that is false. The statement that is false. Early adoption of the new standard is permitted. The new standard expands the required disclosures. Existing leveraged leases won't be grandfathered in. Sales leasebacks must qualify as a sale under Topic 606. Okay, so let the votes begin. Okay, why don't we leave it open for 3 more seconds? So 3 and 2 and 1, and we'll close the poll. Grant, do you want to give the right answer?
Yeah, I think we made these questions too easy, Tom, because the audience keeps on getting all the answers right with a strong majority yet. The only false statement there was that existing leverage leases won't be grandfathered in. They will be grandfathered in, and the other 3 statements are certainly true in terms of early adoption and the required disclosures, and with sale leasebacks must qualify as a sale under Topic 606. Okay, so in this next section, we'll provide some best practice recommendations and things you should be thinking about now as you start implementing the new accounting standard and as the new standard becomes effective. So number 1 is to start assessing your existing leases. So think about how leases are currently being used and how they impact your business model. The accounting and finance team may want to meet and work in conjunction with the operations team to think about how the new standard will impact your business operations. For instance, a key determination for certain organizations has been whether or not to lease or buy an asset. Leasing an asset at times may result in less liabilities on the balance sheet, but now since essentially all leases are kept on the balance sheet, you may want to revisit your buy versus lease decisions. Item 2 is to assess and update your inventory of lease agreements. So look at all your current lease agreements, identify those lease agreements that will still be in effect and still running when the new guidance comes into effect. may want to consider compiling a database or a spreadsheet and taking down the key terms and conditions of those leases so that when you have to implement the change, you have the necessary data available and it's not a scramble to get that information ready for you. Number 3 is to consider the potential impact that the new standards will have on your financial reporting. So essentially you'll have an inflated balance sheet now for operating leases. You'll have more assets. You'll have more liabilities. Think about how that will impact your various debt covenants and ratios. Certain companies may have compensation agreements that are tied to company performance, some bonus plans and the like. So think about how these will be impacted by having additional assets and liabilities on your balance sheet. Number 4 is an important one, but look at your internal controls and look at your policies and procedures over lease accounting. You may want to revisit those areas with respect to lease classification and how you go about accounting for leases under the new standard. Especially during the implementation year, you want to implement additional controls over the financial close process to ensure that the initial measurement is accurate and in subsequent periods it's properly accounted for. And then number 5 is to consider the adequacy of your software. Many organizations today are using simple spreadsheets to account for their leases, which is fine because the current lease accounting is relatively straightforward. But under the new guidance, the lease accounting is a little bit more complex, so you may need to invest in additional infrastructure, personnel, and software to make sure that you're accounting for leases with the most efficient and effective software possible. One of the initial concerns that came out when the new lease accounting standards were being proposed was how this would impact an organization's key ratios and metrics, and specifically its debt covenants. So to mitigate some of the concerns associated with debt covenants, the FASB has come out and stated that liabilities arising from operating leases will not be considered debt. So the intent certainly was not to come out with the new accounting standard and put everyone's out of compliance with their debt covenants. So they did come out with that statement. And here we've summarized some of the key ratios and metrics and how we think the new accounting standard will impact these ratios and metrics. Really the only metrics that will be impacted will be those that are tied to liabilities, specifically current ratio and quick ratio. Some of the other metrics that are tied to earnings, such as EBITDA and gross margin, although not directly impacted by liabilities, may be impacted by what's considered a sale now and how the timing of interest and amortization. But we would recommend that you meet with your creditors and your lenders now to assess your current debt covenants and start the dialogue now as to how the new standard will impact your reporting, because it's still yet to unsee how lenders and creditors would view having additional liabilities on your balance sheet. So there may be some tax implications surrounding the new standard with having additional liabilities and assets. And we certainly won't cover all the tax implications today, but we've pointed out a few things to consider. The first impact is with respect to book tax differences and how that will be impacted by having additional assets and liabilities. So we certainly should consider the deferred tax implications that the new standard will have. Number 2, start thinking about any future taxable income. As we mentioned, the definition of a sale and sale leaseback has changed, so that could impact your future income. We talked about leveraged leases already. They will be grandfathered in, but they won't be recognized after the effective date. So think about if you want to enter into more of these before the effective date. There could be state and local tax implications. There's changes to asset balances that may impact your income apportionment among various states. And there could be additional state capital net worth taxes as a result of having the balance sheet changes. But overall, there likely will be some tax implications. We strongly recommend you consult with your tax team sooner rather than later to determine the extent that the new standard will have on your tax positions.
Okay, so now we are on our polling question, number 4, which is our last polling question. And how big of an impact will the new standard have on your financial reporting and operations? And your choices are no impact at all, moderate impact, or significant impact? So we're going to leave the poll open for a little bit more as you guys jump on. And remember, for CE, you need to have answered at least 3 of these 4 polling questions. So why don't we close the poll in 3 seconds. So we've got 3 and 2 and 1. Okay, Tom, what do you think about the answers that we got here?
Well, it's not surprising. 74% said moderate impact. I thought significant impact might be a little higher, 17%, but obviously between the two, 91% has either moderate or significant impact. So not surprising. This is a big standard that changed lease accounting, and it was expected that it would affect a great number of companies.
All right, thank you again, everyone, for joining our webinar. Again, the objective of the webinar was to provide everyone with an overview of the new lease accounting standard. To wrap up, we talked about the background of what led to the new change. We provided an overview of the accounting for leases, both from the perspective of the lessee and the lessor. Again, lessee accounting has significantly changed with the right-to-use model. The lessor accounting has remained relatively unchanged. Effective dates and how to transition are very important, so mark your calendars with those dates. And finally, we strongly recommend you start thinking about how the new standard will impact your company's operations and your financial reporting. So start that dialogue with your accountants and consultants and auditors now, and meet with your bankers and creditors now, so there's no surprises once the new standard comes into effect. Now, we know we had a lot of questions come in. We only have about 3 minutes or so left. Tom and I will make a best effort to go through via email or follow-up phone call to address all of your questions after the webinar.
Okay, great. So what we're going to do now is thank you very much for joining us, and to remind you to please take the survey at the end of when you close down. You will see the survey pop up. And it was a great crowd and a great presentation. So I want to thank Tom and Grant again, and for all of you joining us. And we will see you again soon. Thank you.